The day the dollar almost collapsed. What if one day, the world's most powerful currency didn't crash slowly, but almost failed overnight? Not in some distant country. Not in a forgotten economy. But at the very center of global finance. The US dollar. The currency that fuels trade, backs governments, and holds the entire financial system together. Came closer to breaking than most people ever realized. Banks froze. Credit vanished. And for a brief moment, the system that powers modern money stood on the edge of collapse. Most people never noticed. But those who were watching? They knew exactly how close it came. And why it could happen again. So, what really happened? How did the world's most trusted currency almost fail, without triggering total panic? Why didn't people wake up to empty bank accounts or worthless cash? And more importantly, if it nearly collapsed once, what's stopping it from happening again? Because this isn't just a story about the past. It's a warning about how fragile the system really is. And once you see it, you can't unsee it. To understand how close things got, you have to understand what gives the dollar its power. It's not gold. It's not physical assets. And it's not even the government, at least, not entirely. The dollar runs on trust. Trust that banks can lend. Trust that markets will function. Trust that when you swipe your card, transfer money, or withdraw cash, the system behind it will work. But over time, that system became something else entirely. Highly interconnected. Highly leveraged. And dangerously dependent on constant motion. Banks lending to banks. Institutions borrowing short-term money to fund long-term bets. Trillions of dollars moving every single day, just to keep things running. And as long as everything flows, it looks stable. But when that flow stops, everything starts to break. And that's exactly what almost happened. The moment didn't begin with a loud crash. It started quietly. Deep inside the financial system. In a place most people have never heard of. The short-term funding markets. This is where banks and financial institutions borrow massive amounts of money, sometimes overnight, to keep operations going. It's like the bloodstream of the financial system. Invisible. Constant. Essential. But here's where things get interesting. One day, that bloodstream started to clog. Lenders pulled back. Confidence dropped. And suddenly, institutions that depended on daily funding couldn't get the cash they needed. Interest rates spiked, fast, Not gradually. Not predictably. But violently. In a system built on trust, that kind of movement sends a very clear signal. Something is wrong. And when trust starts to disappear in finance, it doesn't fade. It collapses. Deeper twist. But the real shock wasn't that stress appeared. It was how quickly it spread. Within hours, major institutions were scrambling for liquidity. Cash, something usually abundant in the system, became scarce. And when cash disappears, everything else starts to fall apart. Because without liquidity, banks can't lend. Without lending, businesses can't operate. Without operations, the economy begins to stall. And suddenly, the dollar itself, the foundation of all of it, starts to feel unstable. Not because it's disappearing, but because the system supporting it is cracking. And here's the twist most people missed. This didn't happen during a visible crisis. There was no immediate stock market crash. No public panic. No lines outside banks. From the outside, everything looked normal. But underneath, the system was under extreme pressure. And it was getting worse by the hour. So, what actually saved it? Why didn't everything collapse? The answer is both simple and deeply unsettling. Intervention. Massive, immediate, and largely invisible intervention. When the system began to seize, the central banking system stepped in, injecting liquidity directly into the financial markets. Hundreds of billions of dollars flowing into the system almost instantly. Not printed in physical form. Not handed out publicly, but digitally created and strategically deployed. This wasn't about helping the economy in a traditional sense. It was about stopping a chain reaction. Because once liquidity dries up, the system doesn't slowly decline. It collapses all at once. Think of it like this. Modern finance isn't built like a solid structure. It's built like a network of dominoes. Each piece depending on the next. And when one falls, the rest follow quickly. So, the intervention wasn't optional. It was necessary to keep the entire system standing. But here's where things become more complicated. That intervention didn't fix the problem. It paused it. It restored confidence temporarily. It restarted the flow. But the underlying structure? Still fragile. Still dependent on constant support. Still vulnerable to the same kind of breakdown. And that's what makes this moment so important. Because it revealed something most people weren't supposed to see. The dollar doesn't just run on strength. It runs on maintenance. Constant, active, behind-the-scenes maintenance. Without it, the system begins to crack much faster than anyone expects. And that leads to a much bigger question. What are the risks of a system like this? On one hand, intervention prevents collapse. It stabilizes markets. It protects the economy. But on the other hand, it creates dependency. If the system requires constant support to function, is it truly stable? Or just temporarily held together? There's also another concern. Every time liquidity is injected into the system, it changes the value of money itself. More dollars circulating. More support propping up markets. But potentially less purchasing power over time. This is where inflation begins to quietly emerge. Not always immediately. Not always dramatically. But gradually. And often invisibly at first. And then there's the issue of confidence. Because the entire system depends on belief. Belief that the dollar holds value. Belief that institutions will function. Belief that intervention will always be enough. But if that belief ever weakens, even slightly, the effects can be rapid and unpredictable. Because once trust is lost in a financial system, it's extremely difficult to regain. And that's the real risk. Not just collapse, but loss of confidence. Because confidence is the foundation of everything. So, the system survived. The dollar didn't collapse. The world kept moving. And most people never knew how close things came. But the event left behind a quiet truth. One that doesn't make headlines. One that isn't talked about often. But one that matters more than most people realize. The system is stronger than it looks, but also more fragile than it seems. It can handle stress. It can absorb shocks. It can even recover from near failure. But it cannot function without constant support. And that raises a final question. If the next crisis is bigger, faster, or harder to control, will intervention still be enough? Or will there come a moment when the system can't be stabilized in time? Because history doesn't always repeat itself, but it often rhymes. And the closer you look at how money really works, the more you realize the line between stability and collapse is thinner than anyone wants to admit.